Hello and welcome back to Financial News. Today's show is being recorded on May 7th, 2019, and Ron Jankowski is off on vacation, so you're stuck with just me today. And again, my name is Paul Munichel. I am a financial advisor with Ameriprise Financial in Orland Park, Illinois. And should you have any questions or concerns, my direct phone number is 708-226-3412. So without Ron being here, I'm just going to take it away and dive right into the show. To the new viewers, we usually start out the show with two topics, and I give just some quick answers on both of them. So the first one I'm going to discuss today is, being that we're in the midst of earnings season, just giving viewers a bit of an update. We are still struggling to get over the break-even threshold on the season, but getting closer. Some data facts. Approximately 78% of the S&P 500 companies have now reported their first quarter earnings results. And as is often the case during periods of economic expansion, earnings have been coming in ahead of estimates. But earnings per share in aggregate are still forecast to be 0.9% below year-over-year levels. If achieved, it would be the first year-over-year decline since the second quarter of 2016, so something to watch out for. Corporate sales, however, they do reflect a much healthier environment. Sales per share are currently on track to generate a 5.3% year-over-year gain, although the typical beat has been below that of the 5-year average, according to FactSet. This week alone, another 59 S&P 500 companies are on the docket to report earnings, so a lot to watch for this week. I also brought some updates on labor productivity and how important it is to keep track of that. Labor productivity, it rarely garners much media attention, quite likely because so few people know what it means or understands or its implications. So today I'm going to expand on it a little bit. Productivity is truly the economy's secret sauce. A sustained uptick could do wonders for the U.S. economic growth and living standards in the decades ahead. In coming years and decades, U.S. economy's potential growth rate is expected to continue to slow, primarily due to powerful demographic changes. Population growth is slowing, and we are an aging society. These are, in fact, the conditions across most of the industrialized world. In straight numbers, from 1950 to 1973, the Congressional Budget Office calculates the U.S. economy had a potential growth rate of nearly 4%. But going forward, the CBO calculates a potential growth rate of just 1.9%. The single most powerful force that could counteract the growth depressant of demographics is productivity. A faster pace of improvement in output per labor hour, which is productivity, would directly boost the U.S. economy or any economy's growth potential over the long term. When your supply of workers is running thin, boosting their individual output can overcome the scarcity of hands working. So going forward, when you hear productivity news, now you know a little bit more what to look out for and why it's important to the economy. This is the part of the show where Ron Jankowski would normally give some market facts, but again, with him being out, I'm going to take over his role. So I just wanted to give you some approximate returns year to date. The S&P 500 year to date, up approximately 18%. That's great. While the Dow Jones Industrial Average, approximately 14% positive on the year. And the NASDAQ, believe it or not, is up a whopping 23% year to date. So all positive, strong start to the year for the major indices. Some things that are declining, one in the commodity sector, I'm seeing CBOT wheat year to date, believe it or not, down 16.8% net cents per bushel. And then going back to the S&P 500, consumer discretionary, year to date, that sector of the S&P 500 is up approximately 22%. So that's one of your biggest sector gainers year to date. While also on the S&P 500, it looks like one of your major sector underperformers is healthcare, but healthcare is still positive, about 4.7%. So all in all, at least the domestic markets, stock markets are off to a pretty good start, being that it's May, we're coming up, believe it or not, halfway on the year. Time's going by quickly, but that's the updates we have as of today. So that's going to conclude the first half of the show. Stay with us. I will be right back with the Your Money portion of the show to go over a specific topic for you guys. All right, thanks for staying with us. And we are back with the second half of the show, the Your Money portion of the show. And today we're going to talk about how much risk you are really willing to accept with your portfolio. You know, if you're like a lot of investors, you may have trouble quantifying the level of risk you are comfortable taking on in your portfolio. Do you like to play it safe, staying in conservative investments, even if it means potentially missing out on bigger returns? Or are you willing to take on more risk in the hopes of capturing higher gains? If you're not sure where you land on the spectrum, consider the following 8 tips we're going to go over today to help define your views on investment risk. So, tip number 1, define your goals. Your financial plan should be structured to help you get from where you are now to where you'd like to be, with key goals such as saving for your college education or your retirement. Your investment strategy should be a key part of this financial plan. Define exactly how much money you're going to need to save and when you will need it by. When your goals are crystal clear, it can be easier to weigh the various risks and choices you must make to achieve them. Tip number 2, consider the general market environment. It seems fair to say that investors' willingness to accept risk increases in periods when the stock market has performed well for an extended period of time. In the past decade, stocks have generally been on the upswing. On the heels of such a positive market, investors' level of confidence about owning assets that are subject to fluctuation may be higher. By contrast, investors sometimes become more skittish in periods when markets are struggling. Confidence in stocks and other variable investments tends to decline when the market is not performing well. Point number 3, accept market moves as normal. It's a known fact that stock markets move up and down, sometimes significantly, which means there's always risk that a particular investment could lose value. Keep in mind, historically, markets have recovered and the reward potential of investing in future growth of global business remains strong. Prepare yourself for the fact that investing is not a smooth upward climb, and a smart strategy can help the market moves work in your favor. Next tip, tip number 4, recognize that time is one of the biggest influences on risk tolerance. If you have a decade or more to reach your goals, such as retirement, you can ride out market downturns or even extended flat or negative markets. If you expect to reach your goals, such as a new home, in the next few years, you may need to think more about how to protect your investments against the impact of market moves. With this in mind, your risk tolerance will likely adjust as you get closer to achieving various goals. Tip number 5. Trust your instincts, but don't make decisions solely based on emotions. If you are worried about what's ahead in the markets or how your finances would fare if another great recession occurred, it may be time to reassess your portfolio to take some risk off the table. Yet it's important not to be overly swayed by the day-to-day headlines. Look for consistent long-term trends or events that impact market fundamentals before considering any action. And be sure that any decisions you make align with your financial goals. The next tip, tip number 6, consider purchasing power risk. Inflation is always a factor worth considering. Simply stated, your money will more likely or won't be worth as much in the future as it is today. It's important to own investments that can help your asset base at least keep pace with inflation and hopefully grow faster than the cost of living. Tip number 7, be mindful of interest rate risk. Fixed income instruments such as bonds, they carry their own set of risks. One of them being that if interest rates rise, bond values could decline. Given that yields are slowly rising from historically low levels, this risk may be more significant today than in other days. And finally, tip number 8, explore ways to stay invested in the market while mitigating some of the risk. Maintaining healthy diversification across a variety of asset classes is a key way to manage risk. Staying invested for the long term and not trying to time the market is another. Dollar cost averaging or investing consistent amounts of money at regular intervals rather than investing lump sums at one time can help you remain committed to your saving strategy. Additionally, products such as variable annuities that allow you to continue to participate in the market's growth potential while locking in gains may also be worth considering and exploring. In conclusion, given your time frame, current savings, income, and other financial priorities, how much risk are you willing to take to achieve your goals is very important to determine. This is the ultimate question you need to answer to determine your risk tolerance. If you want help deciding whether your portfolio is appropriate for your feelings on risk, consult a financial advisor who can provide you with a second opinion. And if you're looking for an advisor to potentially give you that second opinion, feel free to reach out to me directly. Again, my name is Paul Munichel. I am a financial advisor at Ameriprise Financial in Orland Park, and I can be reached directly at 708-226-3412. And that's going to conclude the second half of our show, the Your Money portion of our show. We will be back next week with updated topics, and Ron will be back with us as well. So we're going to sign off today. Wish everyone viewing a happy investment day, and we'll see you again next week.